Coming up today, stocks bounce back, inflation is still slowing down. Can the Fed still cut in September? Does the market pullback have further to go? The latest earnings season's data, oil finishes lower, the Feds go after Andrew left, and I get you all prepped for next week. It's going to be a big one, guys. Let's go. Welcome back to Click Capital, everybody. Hope you're doing well out there. And if you're new around here and interested in the stock market and staying up to date on financial markets, then subscribe to this channel and these videos will show up in your feed every day. And a big thanks to all my loyal viewers for hitting that like button and your continued support of this channel. Okay, so we finished the week with a little bit of a bounce here on the S&P 500, 54.59. Getting a little bit of green color up the front in a few sectors. Still say it's a bit too early to call yesterday a short-term bottom though. We didn't quite get to oversold levels on all my indicators. Still got that rotation going on into small caps though. Russell 2000 finishing up 1.65% today, actually shaping up on the chart here, kind of putting in a bull flag. This big volume. Then we've seen price kind of coil up a little bit. The little spinning doji there today on higher highs, higher lows. May have a look on the upside next week. Pretty strong volume breadth as well. 4.68 more volume in advancing stocks than declining stocks. Same with new 52-week highs versus 52-week lows. Still looking really strong. Classic VIX crush Friday, down 11.3%. Still may get another chance next week to sell some juicy option premium if you're into that sort of stuff. And the bond market continuing to price in a Fed rate cut around the corner. There's a 2-year dipping down again today in terms of its yield, 4.38%. Now getting almost a full percent below where the Fed's currently at. And if I just go out to a monthly chart on the 2-year yield and just remove all the indicators for a second here and overlay it with the Fed funds rate, we can see currently at 5.25. Just zooming out in history, you'll often see the 2-year lead the Fed. We can see it back here in late 2021. Yields started to climb. The Fed eventually followed them. Same deal in late 2018. Yields put in a top, traded below the Fed funds rate. They're a little bit ahead of the Fed there. And you'll quite often see this pattern going back in history as well. That's why the bond market, kind of like a leading indicator, and a lot of the time will get out in front of the Fed. However, that's still yet to be seen. I think it's fair to say we could draw in a support box around here on the 2-year, somewhere between 395 and 420. If it were to decisively take out this support box here in the next month or two, then that's setting up a pretty large divergence between where the Fed's at and where the market's at. And looking back in history, the Fed will most likely catch up. So I'd say the odds are still heavily weighted to a rate cut in September, but possibly in December as well. But for now, a lot of investors, small and large, are piling in to the short end of the bond curve. A lot of investors don't want exposure to the long end. Worried about US debt. Long-term bond yields staying elevated. That'll keep downside pressure on long-dated bond prices, but short-term bonds got a bit of the wind at their back if the Fed is on the cusp of cutting. Still constructive price action in high-yield bonds, holding up at their yearly highs. Not too much action in the dollar this week, calling up around 104. There's the dollar yen, which has come off hard the last couple of weeks. Bit of fear out there in the markets that the unwinding of the yen carry trade could accelerate and potentially blow up financial markets. And for sure, there is a lot of hot money in the yen carry trade. However, two things: Japanese interest rates are still pretty much near zero, just above rock bottom. Still a huge gap with the rest of the world. So I don't think the carry trade is going to disappear overnight. Plus, just keep in mind, if things get bad enough, central banks will always step in and backstop it all anyway. Nice little bounce there in Bitcoin today. Commodity index as a whole, still a little soft here thanks to crude oil. Acting a bit better today was the precious metals, gold and silver, still trying to find some support. There's a rotation into small caps from large caps, inching a bit higher there today. And looking across stock sectors, it was green across the board, bullish breadth of a day. That's what you see in a bull market. Funny enough, it was home builders, the strongest sector today, up 3.3%, breaking out to new multi-month highs. Pretty good day for financials as well, including regional banks, continuing to walk the line. All these sectors that had been underperforming so far this year, up until about a month ago, are now all of a sudden putting in a huge catch-up on this monster rotation. And there's a look at the largest stocks in the market, most of which are going to be reporting their earnings next week. Got a big week next week. Mega cap tech earnings, along with the Fed's interest rate decision in their latest commentary on Wednesday morning as well. So it'll be interesting going into that with a lot of these mega cap techs having a sharp pullback these last couple of weeks. Whether earnings come in really good, most of them are likely to beat on estimates. Market's going to be looking for forward guidance as usual. Also, whether they plan to keep up their huge capital expenditure on AI-related products. We heard Alphabet say that they're not quite turning a profit on them yet, but the CEO did reiterate that the risk with AI is not in over-investing, but rather in under-investing. Meta's been hit one of the hardest out of the bunch. They report on Wednesday after close. Same with Amazon, come off these last few weeks, along with the consumer discretionary sector. This being the biggest stock in that sector, We'll get to hear from them after close on Thursday next week. NVIDIA always reports a little bit later. They're still a month away. And technically speaking with NVIDIA, it's now done a 24% drawdown from its all-time high. Technically, some call that a bear market. However, I don't think you can call NVIDIA a bear market in my opinion. It's also subjective. I think a much simpler definition is if the price is higher or lower than a year ago. If it's lower than a year ago, which it's clearly not, I don't think you can start calling this trend here a bear market just yet. Of course, if we take out this big earnings gap from May, then we may have a confirmed short, medium-term downtrend, but that is still yet to be seen. So there's a look at the economic calendar today. Big one, we got PCE inflation data. Core year over year actually came in a touch hotter than expected. Same with month over month, but the headline came in as expected. And even though it wasn't a beat on the downside, as expectations had been coming down and they've matched them, the markets appeared to have somewhat liked that, or at least not got too upset with it. Got consumer sentiment as well, coming in a touch higher than expected. And so the trend of disinflation is still intact. And like I just showed you with the gap between the Fed funds rate and where the 2-year government bond yield is, now around 4.30, starting to get a pretty good gap now in PCE inflation. And again, looking back in history, whenever you see that gap, it does eventually close, and they'll often flip. The rate will go underneath inflation, then it'll flip back. However, looking back in the late 90s, there can be a large and prolonged gap between the two, and just like in the early 2000s, that can close quite sharply. However, we are starting to approach the long end of the averages for how long the Fed has stayed on pause. They last hiked in July last year, been 12 months. A lot of the times we don't go much further than that before they start cutting. And so just looking at some research from Goldman Sachs with that core PCE data we got today, looking at the last 3 prints we've got in that, annualized that comes in at 2.31, getting closer to the Fed's target. And if Goldman Sachs is right with their forecasts, looking at core CPI we get on August 14, another core PCE we get on August 30, along with 2 more in September before the Fed meets on the 18th, they're expecting 3-month annualized data to start hovering around 2%. And if true, I'd say that's the green light for the Fed to go ahead and start cutting, especially if we saw another uptick in the unemployment rate. That's pretty much the 3 most important data points going into their decision. There's the CPI, PCE, and the unemployment rate, or just the jobs market as a whole. However, the Bank of America thinks they won't cut until December, saying they think the Fed can afford to be patient. They said there's too much of a consensus around a cut happening in September, and we'll get to hear a bit more about that from Jay Powell this coming Wednesday. He may come out and push against the idea of a cut in September as a way to use his language to tighten conditions. However, the election in November does throw a bit of a curveball, as we're not really sure how that's going to play into his decisions and thinking, as it could look quite like a political driven decision if he does cut in September, the last meeting before the election. And even though he will well and truly face a lot of criticism if he does go ahead and cut in September, I believe it's actually justified. Just looking at the data out there with inflation, jobs, global central banks around the world as a whole are getting back into a rate cutting cycle. And like I said, there is the gap there between inflation and the Fed funds rate. So I wouldn't necessarily criticize Jay Powell as having done it for political reasons. I'd actually agree with the market that 5.25 could be a little restrictive here, and there's definitely room for it to come down into the mid-high 4s over the next 6 months if inflation data keeps allowing for that. So that's the update on inflation and interest rates. Just getting back to the stock market, looking at a chart here of the returns of this bull market so far. Since we bottomed in mid-late 2022, indices sharply bounced back last year, led by NASDAQ and tech here in the blue line. Even after this retracement, still up 71% in this current cycle. And even with that huge rotation into small caps, they're still only up 38.6%. Still a really large gap between the top and the bottom. But like we've been seeing, some of the most popular trades that really accelerated straight out of the gate this year have started to reverse, some saying even coming undone. Not just tech stocks, but the Japanese yen, copper. Now we're also seeing those GLP weight loss drug stock having sharp pullbacks as well. Bitcoin's actually done pretty well, considering all that, kind of hanging in there. And of course, we've seen the beaten down sectors, value, smalls, regional banks, all perking up with some huge volumes. I'd say a lot of institutional money have had quite large open profits on mega cap tech. A lot of the sector priced at 30 times earnings. And they're looking at small caps, many of them priced around 10 times earnings. And I think that's what's causing them to do a bit of rotation, as they think the Fed's going to start cutting rates, which is a bit more beneficial for small cap. But like I said, for the here and now, we may not have seen the bottom in this current pullback. It could still go on for another month or two. Just looking back in history at the percentage frequency of S&P 500 negative total returns by calendar month. We're on the cusp of going into August. That's actually the second worst month, September being the worst. Like I said, quite often get a bit of seasonal weakness around this time before the market bottoms. Typically the last 2 months of the year are some of the best. And so we're just getting into the thick of Q2 earnings season. Just looking at the numbers so far, earnings beats are coming in a little bit better than long-term averages, around 78% there. However, revenue beats, not the best, actually coming in a little bit below the 10-year average, around 56% or so. That's something we're going to keep an eye on. May also be adding a little bit of weight to this market for the here and now. And so even though tech sector's been pulling back, mega cap tech, definitely semiconductors, and for sure there's a Taiwan risk now going into the presidential election. We don't know exactly how that issue is going to be treated or will unfold over the coming months going into next year. One thing's for certain, the huge amount of spending on artificial intelligence has skyrocketed this year and is expected to firm even further going into next year. Looking at Alphabet's CapEx this year, expected to come in just under $50 billion. That's a huge amount of investment. They're really playing this for the long term. And so it's just really hard to ignore these numbers. And so I definitely wouldn't rule out mega cap tech and say they're about to go into a bear market or anything like that. We may just be in for a little bit of a period of consolidation. However, we'll get a really good look at that next week when we get to hear more earnings. We've already heard from Alphabet, and their numbers were actually pretty good. And analysts as a whole are expecting the S&P 500 earnings to put in some pretty good growth this year and accelerate even further into next year. And the interesting thing is, this is kind of in direct contrast to what the bond market is telling us with the inverted yield curve. It's forecasting a recession over the next 6-12 months, just looking back in history, especially if that gets back into uninverted territory. Still got net profit margins near the top end of their range, something that's really improved in the American stock market over the last 10-15 years. Net profit margins 12.1%. And just moving over to commodities, still a bit heavy thanks to oil. Still hopes that Israel and Gaza can work out a ceasefire deal. Still not getting the best economic data coming out of China. Their big state meeting was a bit anticlimactic. Investors didn't really hear new big economic measures and stimulus. Instead of their usual blustering approach, they're now focusing on quality, which is probably the right thing to do for them long term. And again, with the uncertainty of the US administration and the potential for more Chinese tariffs, that's probably got investors taking pause on China as well, and then thus oil as well, since they're a huge consumer of oil and other commodities. And so there is still the risk in the commodity market that Chinese economy could have another leg down. There could be a new US-China trade war that does harm them. And there's still that trend of reglobalization, where a lot of Western companies have been delevering and diversifying their manufacturing out of China, something that's been going on ever since COVID. So it could be a little bit of a headwind for them. However, their economy is still growing at 5%, but their capital markets are still well and truly lagging behind their actual underlying economy. Here's an interesting visualization of how big the oil market is compared to the metals market. At 2.1 trillion produced annually. I think a lot of people will be surprised also to see iron ore outpacing gold at 283 billion. Coming in third, copper. And I think a lot of people will be surprised to see how tiny silver is. Only a $20 billion market. A lot of mid-cap companies out there. Bigger than the entire global market for silver. That's why when it moves, it can move really big because it's like a small cap commodity. Moving over to crypto, thought it was interesting. US presidential candidate Robert Kennedy Jr., who has a pretty good platform and influence out there, says he's fully committed to Bitcoin. Said most of his wealth is in the digital asset. We also heard from some cities like Jersey City, so they're going to invest in Bitcoin ETFs with their pension. RFK even went as far to say if he made it as US president, he would buy over 500 Bitcoin a day for the US's strategic reserve. And he's previously come out and said he wanted to put the entire US budget on a blockchain, which I think is a pretty interesting idea. Regardless of what you think of Bitcoin and its valuation, I've always been a believer in blockchain technology. Decentralization helps create a lot more transparency. And so for all governments around the world, putting their budgets on the blockchain, I think is not a bad idea at all. And like he was quoted as saying here, we're going to have 300 million eyeballs on our budget. And if somebody is spending $16,000 for a toilet seat, everybody's going to know about it. So it does create a lot of transparency and accountability. And who knows, it's possible if Trump and Vance get into the White House, they're very favorable of Bitcoin. JD Vance actually owns Bitcoin as well. Could be the potential for them to do the same things that RFK is talking about. But regardless, for the here and now, Bitcoin, which usually correlates with risk on, risk off mode, NASDAQ, meme stocks, call options, and liquidity in general, it's actually seen a nice bump up this last couple of weeks, along with small caps and value. Acting a little different here, and not that far off all-time highs, just a bit below $74,000 a coin as well. So my last stock pick for my members was actually a crypto-related company. I think it makes a bit of sense to have some crypto exposure here, given we could have the tailwind of a new US administration that is pro-crypto. And of course, more and more ETFs coming to the market, allowing for institutions to invest in it. And I don't think blockchain technology is going anywhere. And so I know I've fundamentally spoken against Bitcoin in the past. I don't hold any in my long-term portfolios because it doesn't yield anything. I'm more like old man's gold for that sort of stuff. However, for my stock picks, that's a trend following strategy. And so I don't care what it is. If it's going up, I want to have a position in it. I want to diversify my portfolio. And like I told my members if we break out again to all-time highs on Bitcoin, I'm probably going to add another crypto-related small cap company into the portfolio as well. Moving on today, we've just gotten news that one of the most famous and vocal short sellers of recent times in the market, Andrew Left from Citron Research, has been accused of fraud and market manipulation by the Feds. Justice Department alleges that Left knowingly exploited his ability to move stock prices. Citron Research founder was charged with 17 counts of securities fraud on Friday, as well as making false statements to federal investigators. Left's regularly used social media and TV appearances to promote his research as a short seller. He's also had some backfire on him. He got short in GameStop in the meme mania. He's also been a long time bear on Tesla. It worked out too well for him. So short sellers already have the hardest job in the market as it is, fighting the strongest long-term trend in markets of rising stock prices. However, when you go around telling people it's like taking candy from a baby, you're just going to attract the wrong type of attention. Also, apparently engaging in some other dodgy behavior, like touting phony positions and making secret deals with hedge funds, were at the heart of the fraud authorities say Left engaged in. And it's funny just looking at his profile over on X. It was just a couple of weeks ago. His last post was actually highlighting Bill Hwang, who was just found guilty after the massive collapse of his hedge fund, and he said justice served. Also ironic, just a couple of weeks ago I actually reported on this show that Andrew Left and Citron Research was calling out Roaring Kitty for manipulating GameStop, even though he was just posting screenshots of his position. It's a bit of a pot calling the kettle black, if you ask me, since he'll go all over financial media, absolutely trashing companies, and then to sit there and call someone else as manipulating the market, I think he needs to pull his head out of the sand. Anyway, looks like he's going to get his day of reckoning as well. Just getting you prepped for next week, biggest week of Q2 earnings season. Start off on Monday before the open with McDonald's. Economic data on Tuesday, JOLTS jobs opening. Couple of stocks before the open. Big ones after the close Tuesday, Microsoft and AMD. Wednesday morning, we'll start off with the Fed interest rate decision. We won't hear from Jay Powell until the afternoon at 2:30. Bit more jobs data. A few big stocks after the close. Meta, Qualcomm. Thursday, we'll start off with manufacturing PMI. A few stocks before the open. Big ones after the close. Apple, Amazon, Intel. Then a couple of energy stocks before we open up to trade on Friday. And I invite you to come back to this channel around this time tomorrow. I'm going to be uploading a tutorial video titled Top 10 Ways to Up Your Investing with ChatGPT. I'm a heavy AI user. I use it a lot as part of my investing process, and so I'm going to share all the things I've learned and techniques with you as well. And so don't get caught up in this whole AI's bubble, AI's doomed, and all the fearmongers like that. Even yesterday, you'll see some of the biggest financial channels out there telling you the stock market's about to crash. They're just doing that for their own benefit to get more views and clicks. It does nothing for you long term, filling your head with fear. So I'd encourage you to lean into AI and at least open your mind up to potentially using it, not just for investing, but I'll also touch on a few other ways I use it. And so I think you'll find that really interesting and valuable. And you might be surprised at just how much you can use it for. Not just for learning, but also for researching, comparing, analyzing, and even using it as kind of like your consultant to help make you decisions. So come back to the channel this time tomorrow, and I'm sure you'll really enjoy that one. Just getting back into the charts, there's the relative performance for major assets over this week. Small caps right up in front, up 2.89%. Down the bottom, silver, Nasdaq, S&P 500 and oil, along with commodities. Also holding up this week, real estate and Bitcoin. And just switching over to all stock sectors. Surprisingly, even though commodities pulled back, we had the materials sector lead this week, along with utilities, financials, and healthcare. Down the bottom, consumer discretionary, tech, and communications. And there's a look at the composite chart of mega cap tech, with a lot of them reporting next week, pretty much sitting right at this area of support. So it'll be interesting to see whether we get a bounce with their earnings next week, or whether the Nasdaq has a bit further to go on the downside. Wouldn't surprise me if it does. On the same token, Russell 2000 small caps, pretty bullish chart pattern here. And like I just showed you, market breadth still holding up really good. Volatility is not all that bad. Volatility risk premium has actually come down this week. That's the difference between the VIX and realized volatility. So that can be a good sign for the market. And another sharp turn down in implied correlations as well. Bond yields definitely supportive. Cost of capital and yields coming down, and high yield bonds still sitting pretty as well, along with Bitcoin. So it's really stocks like NVDA, Amazon that we'll get to hear from next week, along with Meta, Microsoft, and Apple that have been pulling back, and we'll see how they respond to earnings next week. And like I said, just looking at my S&P 500 oscillator, we could still very well go into oversold territory for a few days, and we may just come down and even test this level around 53.50, where I'd say that oversold reading could occur, and we may find some support where the market's previously turned before a little bit. Otherwise, for now, it's not a really convincing look of a short-term bottom here when it comes to the S&P 500. That's all for the daily market review this week. Thanks very much for tuning in with me. Appreciate all your support, and I hope to see you again tomorrow for the ChatGPT tutorial. I think you'll find that really interesting. Cheers, guys.